Hello, this is Cryptolyze. I hope you are well. On this Saturday, September 2023, we meet today as usual for our weekly analysis. We are going to come back to what happened at the macro level on BTC, on crypto, understand a little bit the figures that we got. We will see that Powell's speech still had a major impact on macro, and we will understand why. And you will see that we are entering a cycle which is different and which will really impact BTC, and we will understand precisely why. It starts right away. We will necessarily start with Jerome Powell, the announcement of 5-5 in rates. So we have not changed the rate. Why that has an impact and why we took a big slap on the SP 500 and the NASDAQ. And why will this play a role in BTC? So you have to understand that it's not so much the increase in rates. It's exactly what I explained to you in the daily newspapers. It's Jerome Powell's speech, the tone that was set, and the image that was given. Overall, he said he was going to stop the vice to see what was happening. Okay, he said he could increase the vice. So on this probability of vice, in fact, we could even say that the speech was relatively aggressive by saying that here, calling into question a little the soft landing, the fact that he stuttered at a given moment, all these elements make us say that there is a tension at the macro level which is arriving, and hence the very strong reaction that we had at the level of the SP 500, in which on the blood species, we still had a week which was really marked in the red. So what made an impact? Why is it like that? And what really triggered these elements? First thing is the fact of having explained that it was perhaps going to increase by 0.25. Clearly, personally, I think that it is not going to increase 0.25. I think we are in this plateau zone in which everything will remain as it is. But then why is he talking about it at this point? Well, quite simply, he's not going to say we're going to stay at 5.5 to send an image at the level of an economy which is relatively overexposed at the moment by saying, go ahead, continue to speculate by saying, see, it's okay, we're going to make a pivot soon. No, we are not in this approach at all. We are in a process of temporalization. We are always there to support the economy, to reduce inflation. Don't forget, we are reducing economic power to reduce inflation. We are not going to give positive news in which we will have an injection of liquidity, which will start to rise again, etc. We are really in an approach which is totally different. So for me, we is rather in something where we put pressure on the markets to have a breathing which is rather classic and a delay. And for me, we will not necessarily have a rate increase. If we have a rate increase, it is because we really have very, very bad news in terms of the inflation that is coming. But as I explained to you, inflation is driven by what? It is driven by oil, which is making us crazy. We will come back to this. Everything I explained to you here, you will understand precisely where we arrive and why it is an impact on the BTC. But therefore, we are in a process where we will support. And second thing is that we have perspectives here at the level of the survey, which was carried out as usual, which we often find. HOP, it's here, the manufacturing index, HOP, which is there. And generally, I always like to read those things. What interests me is really the feedback that is there, which is that overall, three things are noted. One, that the economy, in any case manufacturing, is doing more or less well, that we still have difficulty financing, and we have difficulty recruiting, okay? These are the elements that remain in it. So we still have this problem of unemployment, we still have this problem of recruitment. So you'll tell me about that, but it's a bit contradictory. Yes, I agree, but it's not because we have recruitment problems in one area that we can't have an unemployment rate that continues to increase in another area, okay? It's the compensation of the two that does this. But this implies that we have an economy which is, at that moment, divided in two, which is divided on one side on a part which is in overexpansion, which is carried, when we look at the NASDAQ, clearly by the GAFAM and by the bubble of artificial intelligence, therefore, professions which are very strong, and alongside the industrial professions which are suffering enormously. And it is these industrial professions which carry the American economic fabric. And so there we, in fact, have a dissection between the two. And that is worth remembering because we are going to come back to it in particular when we look for the relationship with the BTC. Why does it impact BTC? Second thing, you have to understand that Jerome Powell does not want to have a sectoral rotation now. So what is a sector rotation? It's switching your assets from one pool to another, okay? The principle is as follows. Currently, I have an upward acceleration throughout this period at the level of the NASDAQ, at the level of the SP 500, so I am going to benefit from this acceleration. So I'm going to inject my liquidity, hence the acceleration, because everyone is injecting their liquidity into these parts. Once the yield is over, so the acceleration is over, I will take my profits. So I will potentially manipulate with a week off zone. And then these profits, this money, I'm not going to let him sleep. We don't forget that we have inflation. It hurts. What am I going to do? I'm going to place it somewhere else, and I'm going to look for things that are going to be interesting. And that's where it's interesting to see is that this sectoral rent generally happens in something else currently, and we look for the profitability risk ratio. It's always this notion. If we have 20% return, it means that we potentially have 10% risk or 15% risk. And we will always look for this possibility, this gap between the two. And there we have something for a certain time which has been coming back. We see it very, very clearly. It is here. It is the notion of real rate. So I think you heard about it from Powell in the speech. I also discussed it in my daily life. This notion of real rate is very important. This means that this is the money we are paid to be able to hold American debt versus inflation. What does this imply? This implies that is the rate I am paid to hold bounds higher than inflation? At that point, that means that I hold what is the least risky in the world in terms of investment, what is considered the least risky in any case, to have a return that is higher than inflation. This means that, for example, inflation is 3%. I have a return of 5. So overall, my net return is 2. Okay? 5 minus 3 equals 2. Rather classic. So that means I'm outperforming inflation with something that's safe. What is the point of taking a risk for something that will perhaps make a 6, 7, 8% return with, well, at that moment, a risk that will perhaps be 5, 6, okay? There is no interest. At that point, I'm going to go for something that is almost risk-free, okay, because the probability of a U.S. payment default is still relatively low, meaning that it's still always, and it will remain so for the next 10 years, the board. A ticket to the world. So at that point, there is no point in looking elsewhere. And it is this notion of transfer of equity, which is part of the notion of sectoral rotation. That is to say that I transfer equity here from stocks, therefore from assets, which are already a little more risky, that the bounds towards the American Treasury bonds in which I will have a valuation. I believe that I have the valuation here. When we look, we are at 5% in the 2-year bonds. We broke. The tops, when we look, we broke down the tops of 2007, 2007, and 2006. So when am I going to look for something else? And so there, the notion of sectoral rotation means saying to yourself, am I going to invest my money over 2 years, 5 years, 10 years? Because that's actually what bounds are. That is to say that I buy a coupon and this coupon behind it, we will give it back to me plus all the accumulated interest on, for example, if I buy it 2 years, over 2 years, okay? So it's a big interest. It means that I guarantee a return of 5% for 2 years, and that's enormous. And so at that moment, this sectoral rotation comes from the fact that I'm going to sell here potentially my NASDAQ, my SP 500, the performances that I have achieved, I am going to transfer them to the bounds, and that is important because that means that I am going to transfer to new bounds, and that is really important. That means that these are going to be new good treasures to be able to precisely benefit from these rates. Because the old ones who are on the secondary market, people who bought balloons 20 years ago, or even let's say 5 years ago when it was almost 1%, 0%, I'll even say hop talk. We're going to find out who bought in 2021. Sorry, in 2021 we were at 0, so it has no value now. We know that this money depreciates in relation to inflation, and therefore that is why we also have a crisis, what we call the ETTL here, which is the representation of an ETF, which is a basket of bounds, in this case US, which in fact gives the general secondary price of Treasury bonds. That is to say that this coupon that I bought from the US Treasury, I can resell it on a secondary market. But we see that it is collapsing because there is a rotation which is very strong, and it is also a bond crisis, this notion of bond crisis. I have already spoken to you about it. In the year to come, we know that there are a certain number of pension funds, hedge funds, which are overexposed to bonds and which are in negative, okay? Very clearly, we know that they are negative. If they ever had to sell absolutely all their bonds, well, they would certainly file for bankruptcy. So there, we are in this liquidity crisis in which we have a transfer between the two, and that is why the Fed wants to avoid that. Because if we have a transfer between the two, it is clear that we have a form of immobilization of capital, and that the capital no longer goes into the economy, but goes into a classic structuring in which we will have an immobilization of capital. And that is not something that is desired now, especially since this could lead to a bond crisis, which would lead to an acceleration in the bankruptcies of American banks. So all that to tell you, because this is the important element, is that here we are currently in a search for safe. We are in a search for a reduction in risk. So there is no point in taking risks. On the other hand, what happens when we cross to the other side? Well, on the other hand, it implies that there is no point in owning bonds because the rates are lower than inflation, which often happens. That is to say that we have a bond rate of 1% and that we have inflation of 2%, which is a bit the target of the Fed. Well, we are at less 1. This implies that we lose 1% every year by holding bonds. But at this moment, we will look in our portfolio to have yield, to have performances. And so at this moment, we will look for stocks. We will look for risky products, in particular cryptos. And there you begin to understand the shifts in relation to everything. That, and therefore there currently we are not in a transfer of liquidity which is conducive to crypto because we have a valuation which is very important, which is linked here to the valuation of the bonds of the American Treasury. So here we are in a sectoral rotation in which we are having capital flows which are heading here from NASDAQ towards the bounds. We really feel it very well when we look at this weekly closing that we have. We really had a closing that is very, very violent. And when we set the target of first impulse, retracement, second impulse, ABC, classic, and a retracement, we have the target of 1, which is here, which is the gap zone that we have in mind. Since a certain time, okay, which corresponds moreover, if we quickly look at the top, in fact, of this zone, we see it very, very well. And then we have a second target, which is the 1.618, which is for me the final target, which is really the overexpansion that we can have with the 4,100 on the SP 500, and which is at the same time the golden number of the Fibonacci sequence, therefore which is very followed in the Fibonacci extension in the tool itself. And we see that it corresponds to a very important zone in which we had here a resistance, second resistance, third resistance, fourth resistance, fifth support. And so there we can also have a support setup. And what is interesting to see is that we actually had an acceleration following the rupture, a retest, and it was the first retest which held in the form of support before having the acceleration. So we have a confluence zone at the level of the different indicators. We say, okay, we are in the perspective of going to retest the rupture zone. And if we take a step back, we can clearly see that we have this deceleration zone. So this whole period, which was very aggressive on 2022, and overall on which we have a recovery at the end of 2022 and the beginning of 2023 with an upward acceleration. So here we are going to retest here the high break zone. The first and the second period is the low break zone, in which we really, in fact, generally have this liquidity zone, which is on hold. So what is rather consistent here? So we will have a transfer of liquidity from these zones to the bounds as long as the bounds are still relatively high. And namely, that there are two possibilities to return to a rate which is negative. Either we have rising inflation, something we obviously don't want, or we have yielding, therefore the rate of bounds is decreasing, and therefore at that moment we will have a valuation of the two and a rebalancing of the two. Clearly, the closer we get to zero and go below, then the closer we get to zero, the more valid it is, the more we will have a transformation of this rotation. Suddenly, we will have an overexposure to the treasury bond, and therefore at this point, we will have a transfer of liquidity which will take place at that time, which will return to assets that are a little more risky to always regain yield. So why do we have this? Why do people try to do this? Because you have to understand that it is not the same temporality as you and me. We are not in a retail dynamic. We are not in an investment dynamic. We are in a pension fund dynamic in which they must serve an annual percentage. It is important to understand that a classic fund has an obligation to serve 3, 4, 5, 6, 7, 8% depending on its contract. If they do not serve them, they may have penalties. If they don't serve them, they may lose customers. The goal is to always go for the short term because it is annual, to go for the short term where it is the most interesting. And therefore, that is why we have these transfers. Is this the best way for us? Not necessarily in a long-term dynamic. This is where the notion of objective, what is your objective, and how long will come into account. And I will make a video for you in a very, very short time. I don't know if it's today or tomorrow on that because it's important to understand that we are not in the same dimension and that we really have to concentrate on ourselves. That being said, at that point, when will we have an interest in BTC? Clearly, we see only two things. One, we still have this resilience of BTC. We fell enormously at the level of the S&P 500 and the NASDAQ. We really see that we made a very big break both. And yet, when we look at BTC, the BTC hop, it's here, we see that we closed at the opening price of the week because we are on the CME to have the future of institutional investors and to have something which begins and which ends at the same time as the NASDAQ and the S&P 500. We see that we are roughly in the same place, so that means we haven't moved. We had volatility this week, yes, but we didn't move. We didn't have any volatility during the week. When we take the opening of the candle of the week and the close, we are in exactly the same place. You hear that this confirms the fact that we have resilience in relation to macroeconomic events, that we have a decorrelation between the two, a form of decorrelation. I'm not saying that we are totally decorrelated, but in any case, partially. And so it's rather positive, even if we have a colossal crash at the level of the S&P 500. That means that BTC will not crash as much. But here we really have a representation of uncertainty and absence of liquidity here. Clearly, we see it when we see this candle there, when we see this candle there. We see very clearly that we are not, in fact, in a liquid injection into BTC. There is no interest in having risk. There is no appetite to have risk now because we are already in a form of overexposure in a macro which is not conducive. So we have no interest in buying. Here we have more an interest in waiting, in keeping part of the capital and potentially go find attractive prices on purchases. That's why I'm telling you that for some time now, my medium-term bias on BTC has been rather bearish, in the sense that I'm perhaps waiting for a reacceleration also to do a bearish retest, so that I have already explained to you a retest of the 28,600 here in this area, to then go deeper, look for the 23,000, 20,000 to reload and at the same time fill this gap. So for me, it would be completely logical to have this dynamic, and we are in this reflection. So for me, I remain with this idea because at the same time, I have structural evidence which tells me that currently I am not going to have a liquidated injection in BTC, that currently we still have a form of resilience. So that means that we are not going to drop out when there is a drop in the NASDAQ, at least not as much as previously, and that technically we still has other elements. We see that here we have had a cross which has been set up between the Kiju and the Tenkan. We are generally in a form of retracement at the level of Ishimoku to go and retest the 20 zone here, 0. We can clearly see that we have a large solid color here, which is overall the largest solid color we have had for a very long time. So for me, it would be logical to go and retest that. And if you look, we are in the 20-0. What is 20-0 on the CME? Oh, well, what's going on? It's the CME gap. So we once again have a confluence arriving in this area, whether with Shimoku, whether in terms of liquidity, whether in terms of volume. Structurally, we have a call at the level of 20-0, and which would be rather logical. But if we once again take a little step back from that, it's important because in the dailies, we really treat day to day, that's the principle. But in the weekly, we take a step back. We take a step back and say to ourselves that yes, but in fact, it doesn't matter. The idea is that we will oscillate during this period until we have an upward acceleration, a break, and at that moment, a return of fairness and the establishment of the bull run with the halving and everything that happens behind it. So we are in a dynamic where it is logical and we feel things that are complicated to manage because precisely we are in this dynamic of lethargy, of ranging, where emotionally it is always very complicated. So we take a step back. For me, we are still in this bias of saying that we are potentially waiting for a retest here at 28,600, but we are still waiting for a breakdown of 25,200, which is the support zone that we have had for a very long time, which is holding us, which is the breakout zone of the accumulation of coffers that we have had, therefore, which is the first indication of a bullish intention, and therefore, we will have to wait. I hope you like this video. If so, don't forget to leave me a little like in a comment. It supports me enormously. And if you haven't activated the bell, don't forget, do not activate it because otherwise you will miss videos and there will be many that will come out very interesting. Notably tomorrow, 8:30, you will see that I have a little surprise for you for this weekend and we'll see you soon for a new video.